Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, US credit card debt hits a record $1.23 trillion, revealing a consumer paradox that threatens market stability. We'll explore how this divergence points to a K-shaped economy and what it means for future credit market stability and Fed policy. Second, the UK jobs crisis deepens as a bad productivity boom, driven by automation, displaces the workforce. This discussion will reveal how policies meant to help workers are accelerating their replacement and what this modern Engel's pause means for UK wages. Third, a £31 billion US-UK tech deal is frozen, prompting an unprecedented royal diplomacy push to salvage the pact. We'll break down this high-stakes standoff over digital taxes and what this royal intervention signals for the UK's post-Brexit economic leverage. Let's start with a single number that paints a stark picture of the American consumer, $1.23 trillion. That's the new record for American credit card debt. The latest data from the Federal Reserve Bank of New York confirms this, placing total US household debt at a staggering $18.59 trillion. And the key here is that this isn't just about a few people overspending. It's a broad-based trend. This isn't about lavish spending either. It's about a battle to afford the basics. In just the last year, coffee prices shot up nearly 19%. The cost of beef is up around 15%. And over the last 2 years, housing costs have surged over 14%. It's really no surprise that 70% of Americans now say the cost of living in their area is simply not affordable. Some of this persistent inflation, especially in everyday goods, is actually linked to broader economic policies. For example, research from the Federal Reserve itself shows that tariffs implemented in early 2025 contributed to higher prices for core goods, making inflation sticky. That means it's harder to bring down, which in turn erodes the real value of people's wages and forces them to rely more on debt. A while back, we walked through how these tariffs were also nudging supply chains out of China toward places like Mexico and Vietnam fragmentation that tends to keep core goods prices elevated and volatile. We also noted estimates that tariffs had already added roughly 0.7 percentage points to the CPI, which is exactly why the risk of higher for longer interest rates keeps hanging over households leaning on plastic. But that's not the whole picture. The real paradox is that even as consumer sentiment plummets, overall spending is actually going up. Quarter after quarter, one top retail analyst says consumers are effectively trying to muscle through. They're trying to buy what they've always bought, even in the face of crushing prices. This situation presents a fascinating duality. The headline spending numbers are being pulled up by high-income households, which are still spending robustly. On the other side of the K-shaped divergence, however, data shows that lower and middle-income households who feel the pinch of inflation the most are actively cutting back. So these averages are masking a growing weakness at the foundation of the consumer economy. We previously highlighted that confidence gap dynamic when expectations crater, the fiscal multiplier shrinks. Today, the twist is harsher. Instead of parking extra cash, many households are liquidating savings just to tread water while the top end keeps the averages afloat. So the thing is, they are muscling through by any means necessary. Recent data from McKinsey shows nearly a third of adults have dipped into their savings in the last 3 months. Another 29% have reduced their savings rate. And believe it or not, a growing number of people are now using buy now, pay later plans just to pay for groceries. Using buy now, pay later for groceries is a crucial new distress signal because economists see this as a form of hidden leverage. Traditionally, these small loans weren't reported to credit bureaus, so they didn't show up on a person's credit history. Research from the Consumer Financial Protection Bureau found that a large portion of these BNPL users already have subprime credit scores. As we flagged before, that creates a blind spot for traditional credit models and a setup for surprise delinquencies if the cushion disappears. This all begs the question, how long can this last? One expert puts it bluntly, consumers are borrowing more and more to cover the spending challenges they've got, and that obviously can't go on forever. While many are hopeful for the new year, the warning from inside the financial world is clear. As one business expert advises, it's important to be prudent because more difficult times for employment could be ahead. That warning is directly tied to the labour market, which has been the main pillar supporting the US consumer, but we're now seeing leading indicators begin to flash yellow. For instance, data from the JOLTS report shows that the number of job openings is declining, falling to 9.5 million recently. At the same time, the number of people filing for unemployment benefits for the first time is slowly ticking up. For households that have already exhausted their savings and taken on debt, even a small rise in unemployment could be the final domino that triggers a sharp increase in loan defaults and delinquencies. We said a while back that sticky inflation paired with cooling hiring is the stagflation cocktail the Fed dreads. One more reason, the higher for longer rate path we discussed could persist, adding pressure to already stretched borrowers. So the key focal point to watch now is the monthly jobs report and those weekly jobless claims. We were just talking about the US consumer being propped up by a wobbly labour market. Well, across the pond, the UK job market is facing its own seismic shock. Unemployment has surged to a decade high, and at the same time, the retail sector is in a state of collapse, shedding over 350,000 jobs over the past 10 years. Retail vacancies are now at their lowest point in a decade, excluding the pandemic. A while back, we highlighted an early warning sign. Youth unemployment jumped by 85,000 in just 3 months, even while the headline rate looks steady. That mismatch signaled a structural break. Fast forward to today, and that pressure has spilled into the wider market. This isn't just a story of a weak economy, though. It's a story of humans versus machines, and the machines are winning. Retail bosses are pointing the finger at government policy, which has caused the cost of employing a full-time entry-level worker to jump by a staggering 10%. Their response has been swift and decisive. When asked how they are coping with new business taxes, their number one answer was raising prices. Their number two answer, investing in automation. What really brought this to a head was the defensive nature of this automation push. It's not part of a grand, forward-thinking national strategy. We're seeing countries like Germany with its Industry 4.0 program and China with its Made in China 2025 initiative, both comprehensive state-backed plans. At the same time, the UK's approach appears more piecemeal, which could leave it less competitive in the long run. Walk through any supermarket and you'll see it. Self-service checkouts, AI facial recognition, and robotic systems replacing human jobs. This shift is creating a productivity boom with output per hour rising 1.1%. And it's not just retail. As we discussed a while back, entry-level professional roles in sectors like law and accountancy are being reshaped by automation too. What used to be basic analysis and data entry is increasingly handled by machines. Here's where it gets interesting. Economists are calling this a potential bad productivity boom. A good boom comes from genuine innovation that makes everyone more efficient. This bad boom, however, seems to be driven primarily by firing workers in lower value jobs. The data backs this up. A recent survey from CBI, Patemp, showed that the number of businesses planning to grow their workforce has been cut in half, while the number expecting their workforce to shrink has doubled. The global chairman of PwC put it bluntly, we want to hire, but I don't know if it's going to be the same level of people that we hire. It will be a different set of people. So the productivity number looks better, but it's because the denominator, the number of hours worked, is shrinking. This kind of gain is fragile and could easily reverse. But the critical question is, who benefits? The situation is so dramatic that Bank of England Governor Andrew Bailey has warned of job displacement, similar to the Industrial Revolution. We previously analysed his point that this isn't about immediate mass unemployment. It's about roles disappearing and being replaced by work that requires entirely new skills. Some economists believe the UK may be entering a modern version of what's known as Engel's pause, a period during the first industrial revolution when technology and GDP grew rapidly, but real wages for ordinary workers completely stagnated for decades. All the gains went to the owners of capital. We're seeing echoes of it today. While productivity is ticking up, real salary increases in the UK are projected to be just 0.4% in 2025, near the bottom in Europe. The gains from this automation boom are not being shared. This creates a profound irony for the Labour Party, a political movement born from the struggle of workers during that very revolution. Now, policies designed to uplift workers may be accelerating their replacement. For decades, UK firms lagged their G7 peers in investment, partly because cheap labour was always an option. That balance has now shifted. The cost of hiring is up, and businesses are finally investing in capital and technology. The result is a productivity surge, but one built on a foundation of disappearing jobs, especially for young people in entry-level roles. This is creating a very dangerous structural unemployment trap for the next generation. The pace of job destruction is simply outstripping the country's ability to retrain people. The numbers are stark. Youth unemployment for those aged 16 to 24 has jumped to 16%, the highest since 2015. Nearly 950,000 young people are now classified as NEET, not in education, employment, or training. We flagged this dynamic a while back when graduate hiring was cut sharply, creating an experience trap as entry-level roles vanish. And as the PwC chief said, companies still want to hire, but for a different set of people, those with data analytics and AI skills, leaving traditional entry routes exposed. This risks creating long-term economic scarring for an entire generation. Speaking of the UK's economic challenges, another major front has just opened up in its post-Brexit strategy. A colossal £31 billion tech deal between the US and the UK has just been put on ice. This isn't just about one deal, it's a major test of the so-called special relationship in the post-Brexit era. Research shows that this historical alliance now provides diminishing economic protection for the UK, forcing Britain into a much more transactional position where it has to fight for every advantage. Washington has officially paused the landmark agreement, freezing a planned £22 billion investment from Microsoft and another $5 billion from Google. The reason? US negotiators claim the UK has failed to make progress on lowering its trade barriers in other areas. This decision brings both a need for the UK to assert its right to tax what some call digital sovereignty, and comes with the inherent risk of losing that very same big tech investment. The UK introduced its 2% digital services tax to ensure big tech pays its fair share, but it's a major source of friction with the US. This standoff is now a crucial test case for whether countries can have it both ways. This is a stunning reversal for a deal once praised as a generational step change in the US-UK relationship. And in a move of high-stakes royal diplomacy, Britain is now reportedly deploying its ultimate soft power. King Charles III and Prince William are planning separate visits to the US in 2026 in a direct effort to revive the stalled negotiations. Now, get this, deploying the monarchy for trade negotiations is a powerful signal. Experts see it as a leading indicator of a country's perceived weakness in traditional diplomatic channels. When the usual government-to-government talks fail, you send in the royals. The success or failure of this tactic will not only determine the fate of this £31 billion investment, but also set a precedent for how other middle power countries deal with economic giants like the US. The core conflict boils down to a few key sticking points. Britain's digital services tax, which has frustrated US tech giants, and the sensitive issue of granting greater access to British markets for American farmers. So a tech deal is being held up by farming, and it reveals the classic incredible power of the US farm lobby. This lobby has the influence to shape all kinds of trade policy, not just agricultural ones. It shows how a country's modern industrial strategy can be held hostage by traditional economic sectors. This is a huge structural challenge for any nation trying to cut a deal with the US. Now, the monarchy is stepping into the fray. The planned visits would mark the first trip by a reigning British monarch in nearly 2 decades, and it's not just a photo opportunity. Reports suggest the campaign is a targeted effort to mend economic ties, potentially involving discussions with President Donald Trump, and the timing is no accident. A 2026 visit seems specifically designed to manage potential America First trade volatility. This is a charm offensive, a playbook we've seen other allies use. Leaders from Japan and France previously used personalised diplomacy to protect their economic interests. By sending the King and Prince, the UK is using its most unique, non-traditional assets to try and build goodwill and shield its economy. It's a strategic hedge. This is far more than a ceremonial tour. It's an unprecedented deployment of the monarchy into the heart of a tense, multi-billion pound trade negotiation, signalling just how critical salvaging this partnership has become for the UK's economic future. So what should we watch for? The key signpost will be any official statements from US trade representatives following the royal visit. We'll also need to see if there's any shift in the UK's policy on that digital tax or on agricultural standards. In the markets, a successful revival of the deal could boost the British pound and UK tech stocks. A failure could mean more volatility. This really is a high-stakes diplomatic and economic gambit.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.